Dozens of companies are due to report quarterly results this week, including financial giants JP Morgan, BlackRock, and Bank of America. Then later in the week, investors are going to hear from United Airlines, PepsiCo, Netflix, and many more. We'll also get a slew of economic data. It's kind of exciting. We're going to get key CPI inflation data. That's due tomorrow. I don't know whether anything resolves as we wait to see some negative effects. Maybe this will be the week. Maybe it won't. Let's talk markets now with Lori Calvasina, head of U.S. equity strategy at RBC Capital Markets. I wouldn't take your job for all the money in the world, I don't think, Lori, because tariffs are unprecedented in the last how many years? I mean, there were some in the first Trump administration, but the level that we've seen. So you didn't know how to react, and you've been totally whipsawed. So you started the year at 6,600. Then when the market got Liberation Day in March, you went to 57.50.
We went to, actually, I misspoke earlier. We went to 55.50, and we had signaled that that was our bear case, and we would do that if the market broke 10%.
Okay.
We thought.
And then you went up to 57.50 briefly, or something?
We went up to 57.50.
And now you're going back to 62.50 today. The market's at 62.50.
Yeah, and we were right. And we view our targets. I mean, look, targets are madness.
It just seems like you're following the market. Every time the market goes down, you give a new target where the market is. Now you're 62. What good is it?
No, well, look, I to be honest, a lot of strategists don't like doing price targets. I mean, I wouldn't do them. It's sort of an exercise in where is the market going to end up on December 31st of this year. And timing gets very, very tricky. I'll tell you what we were surprised coming off of the April 8th low. We have done in 3 months what we typically do in 9 months in terms of rebounding off of an extreme low. So if you go back and look at episodes like 2010, 2011, 2018, kind of these major 10% drawdowns or more, we should be at around 6,300 by the end of this year, not right now. If you just sort of look at the typical path that we travel. So markets are just processing things very, very quickly. And I'll tell you, Joe, when we went to the 57.30 as our, I think we did that at the beginning of June, we were trying to communicate that we didn't think we were back to where we were to start the year, but we thought we were in a better place than April 8th. What I was surprised about in terms of talking to clients after that, and I got an earful from clients about this in June, they're done with 2025. They're looking ahead to 2026, and they think that they paid the price for any sort of economic or inflation potholes on April 8th. So when we changed our framework this morning on our target, and that's really what we did, a lot of our math was the same, we tried to bring in the impact of 2026 numbers into this year's forecast.
For people that talked about valuation at the beginning of the year and 2 or 3 great years that in 2023, 2024, they really wanted a shakeout. It's weird. This is a weird way that it happened with tariffs. There's always some excuse for it, but it cooled everything off. Some of the leaders that were probably overvalued or there were some air pockets underneath that all got sort of worked through. Now we might, if we had a decent earnings season right now, it might be all clear. Why stay at 62.50? Why not go back to 6,600 where you were at the beginning of the year?
So we don't think the world is the same as where we were back in January.
It might be better.
I don't necessarily know that it's better. I mean, if you just look through the lens of consensus GDP forecasts, they were up above 2% for this year at the beginning of this year. I think right now the number is like 1.5, 1.6%, and then looking again for 1.6% for next year. So the consensus, and this is not just my economist, but the consensus around the street, thinks that we've taken something out. Also, if you have higher inflation levels, that's going to pressure your PE multiples a bit. One thing we talked about this morning.
What if you have lower inflation levels?
Well, look, I can get you some really, really cool numbers on S&P pricing for this year and next year if I take inflation down to 2%. Our economists think we're going to live more in kind of that upper 2% type number, a little bit below 3. So nothing too crazy, but that does dampen your PE multiples a bit.
What about where we stand just on a PE basis? I mean, what are we back at, 22, 22 and a half?
So when we look at the top 10 market cap names in the S&P 500, you're getting close to past peaks, actually. And we also look at the market cap weighted PE, and that's above 25 times now. I see more opportunity if you look at the S&P kicking out those top 10 names. And we're not cheap, but we're not back to those peaks either. Russell is probably your best barometer for how cheap things got on April 8th, and we actually went down to recession lows in the Russell 2000. But now
the Russell 2000's been on fire lately.
Well, it's not having a big outperformance versus large cap yet, but a lot of people are sort of chomping at the bit, thinking we might get it. I do think, though, that kind of this dialing down of Fed expectations that we've seen over the last week or so might take a little bit of the wind out of the sails there, though.